Well, Happy New Year, folks. Welcome to 2022. And this is the first commentary of the year. It will be a light one. Okay. I truncated the economic calendar for the week because just about every country had a bank holiday today. So, because we watched the euro, cable, and dollar index predominantly in Forex, that's the only countries that are showing, but it's just about every country that would be seen on the Forex Factory economic calendar. As a reminder, this is a non-farm payroll week, as you can see down here on Friday. And it's the beginning of the year. It's in the month of January, where it is classically hit and miss. Okay, in other words, we treat January like the accumulation phase of accumulation, manipulation, and distribution. Okay, or power three. We're not in any kind of rush. We're not trying to predict any particular moves for the year. We want to see what the big banks and the large institutional firms and traders will be looking to do in terms of assuming large positions. Hopefully they can tip their hand to us during this month. If not, it's obviously expected in February. But in short, we are observing in January. We're going slow. We're not jumping in. We're not hurrying up. We're rushing. Nothing like that. Okay, so just make sure I have your mindset on the right track. And also, because it's the first commentary, in your calendar, okay, the one that you have at your home or next to your desk or wherever you do your studying, or on your phone, there is a reminder I'd like to make available to all of you again. I mentioned that throughout the year of 2021, that once I get through the lessons up to February of 2022, I'm taking the entire month of March off. I'm not going on YouTube. I'm not going into the forum here. I'm not doing any video work for any of you. I need the rest. Okay, so I'm going to be taking those 4 weeks or so, the entire month of March, the first day of March and the last day of March, and then the first day of April, I'll return back in this seat as we see here, in this capacity. But do not be alarmed. I've been kind of warning you all in advance, letting you know what's coming up. I just need the time. My family and I, they have not had a whole lot of me since 2016. And one of the things I wanted to do in 2022 was dial back my productivity. Okay, and it's grueling. So I want to give myself a chance to rest and spend time with my wife and my family, and we're probably going to go and do a couple of road trips. It's up in the air really what she wants to do still. But anyway, that's a little bit of the housekeeping stuff out of the way. Hope you all had a very pleasant Christmas holiday and a healthy New Year. Obviously, I'm still on the mend with the flu. I have a little bit of chest congestion, so if my voice sounds a little bit off, it's because I'm still nursing that. Otherwise, I feel great. All right, so Monday, obviously, today we had a bank holiday. And Tuesday, we have some high impact news during the 10 o'clock hour for dollar. Wednesday, we have high impact for dollar at 8:15 a.m. for employment change. And then we have FOMC minutes later on, 2 o'clock on Wednesday for dollar. And on Thursday, another bank holiday for euro. Unemployment claims, medium impact for 8:30 a.m. on Thursday, dollar-based. And then 10 a.m. ISM service PMI for dollar. And then Friday, our typical carnival ride, non-farm payroll. So protocol for this week, obviously, is if it were not January, if it were any other month, like February through November, we would look to take our trades by Wednesday, 7 o'clock in the morning. And then nothing new in terms of an entry. We could manage open positions, but we can't assume any. But because we're in January, we do not take trades. We're not trying to rush in. We're not trying to pick a bias. We're not trying to do any of those things, okay? Let the smart money tip its hands. They're smart money for a reason, okay? They have more insight than any of us. So let them establish and assume risk on higher time frame perspectives, and then that gives us the benefit to go in and ride their coattails. All right, so here we have the dollar index's daily chart. I'm going to go through this as briefly as I can because I don't want the videos to be too long. There's a lot of videos that have to be made between now and the first day of March, so I don't want the videos to be, well, too long in the tooth. So we have the expansion on the daily chart here, and while this is always likely, and I would have rather seen it come down and hit that perfectly and then run up into this area here. It doesn't necessarily have to do that. It could stay open, but we're still inside the range created with that PAL event. And for me personally, the bias has not changed. I'm still looking for this up here. Okay, so basically 97.50, we'll just call it that for now. Once 97 big figures liquidity is attacked, I'd like to see it expand up into 97.50, dig into that imbalance, maybe get the midpoint consequent encroachment. And again, that blue shaded area is a old imbalance on the weekly chart, and I'll counsel you to go back out and look at your weekly chart and you'll see what that is. All right, so I have a 2-hour chart here, and you're probably going to be asking, why is he now using a 2-hour chart? All right, sometimes the data doesn't show up nicely where you can see all the candles color, like from green to black to green. If I'm showing you a 1-hour chart, and I want to refer back to this old low, the 1-hour chart is going to show the candle so crunched up that you can't differentiate the green from black or the up close to down close. Okay, so the only reason why I went to a 2-hour here is to show you the distinction of each candle body. Makes it easier on the eye. It may not be that big of a deal to you, but it is for me. But still showing the dealing range low and the dealing range high relative to that, well, monthly dealing range. We didn't take out the low here with this pass down into this area here, but we had a little bit of a run up, come back down into the buy side of balance, sell side of efficiency, bullish order block, rally, runs back up into mean threshold of the last up close candle there. Let's go into a 15-minute time frame. Okay, you can see how the market dropped down in for a Judas swing. The timing on this is actually 6:15 in the morning, so it's a little early, but we have buy side liquidity here, consolidation, leave, return back, distribution, redistribution, smart money reversal, low risk buy, accumulation, reaccumulation. So the market rallies from there and then aggressively runs for the buy side liquidity. Now, I'm not obviously making any bones about having expected this move today because I didn't. It's been the holiday session, so it is what it is. But it's nice to see what we're looking at here in hindsight so that way you can mark up and do all of your studies in reference to all of the distribution side or sell side of the curve and the buy side of the curve here for a market maker buy model. Euro dollar daily chart. Now look at this thing. This range is incredibly frustrating for someone that would not expect that. And again, just to give a high five to everybody here, this is what it's like when you know what you're looking for and what to avoid. And I mentioned that the importance of knowing when the market's going to likely consolidate, so that way you don't go in there and churn your account, which will eventually, if you don't know what you're doing, and you're trying to take trades after trade after trade, you'll blow out. Okay, and the only way I've learned this was by blowing out lots of accounts. Okay, and I've never made any attempt to hide that because it's important for you to understand that everyone has blown accounts. There's been really successful people out there that have struggled initially in the beginning, and if you would have just asked them at the time if they felt they were ever going to get it, they probably would have doubted it. I didn't doubt it. I just kept at it and knew that what I was doing was not right, but I'm going to figure it out. I'm going to fine-tune this and fine-tune that. But more specifically, I wanted to know what time or environment leads to me blowing out. So that's one of the things that you get in this mentorship is knowing where that area is or time period is likely to crop up and plague your bottom line, your results, and your psychology. Because it's important to know that while you can go down to a 1-minute chart or a 5-minute chart, and there's trades going on in this range. There's absolutely trades going on. I'm not trying to say that there isn't. I'm stating that you have to be very, very nimble, and it's unforgiving if you're not nimble. So do I believe that there are traders in this community that are prepared to be that nimble in an environment like that? I don't know them firsthand, and I don't see any evidence that was supplied to me or suggested by anything that I've seen in my student base that would warrant me saying, yeah, I think I have students that would do very well in that range, which is the reason why I teach you to avoid it. So looking back at it now, hopefully you have seen the benefit of knowing what it looks like, why it's beneficial to sit on your hands and not feel bad when you're being instructed to sit on your hands and don't do nothing. Don't attempt to do anything with this market because it's likely to hurt you. Okay, so now looking at it in hindsight, you can see, wow, that's just really interesting, because you can go back and see now without any argument, there's no way someone can say, he didn't see this coming when I explain it to you in advance. So it's one thing to say, here's a high probability condition and it leads to high probability results. Okay, that's wonderful. In fact, that's really the main attraction to learning a method. Okay, because the method that someone has, or a teacher that promotes that idea or system, they're going to sell their strongest points, and that's fine. I don't have an argument with that. I do the same thing. But one of the most important things is having a shield, and most educators don't know how to teach you to shield yourself from, yourself. So if you look at how I'm teaching you exactly how you're going to fall into these pitfalls, these traps, okay, where you think it's going to be easy for you to find setups or it's going to move when it's not likely to. Okay, and that's what I try to differentiate myself from everyone else because of that. I can show you and tell you before it happens when it's going to be high probability, but equally so, and much more importantly, I can tell you when to stay out. It's important for you to know those, because if you don't know those periods of low probability and high odds of you losing and losing your mind and blowing your account, it doesn't matter how good of a system or strengths I give you, because you'll expect those strengths and those offensive weapons where you're looking to get in and take trades, what you think is high probability. If you don't have a way of determining what low probability is, which is the importance of why I teach it to you, because I've had so many students come through and say, I don't want to learn low probability. I'm only here to learn high probability. Well, how can you understand what high probability is without understanding intimately what low probability is and how to forecast that? Because if you can forecast when the probabilities are exceedingly low, that promotes the idea that now really you know what high probability is, because it's the lack of low probability. Correct? Right. But it's unfortunate. Some people come in here, they think they're geniuses, they think they're way above everyone else, and I don't claim to be a mental giant, but to come in here and think that you know what I'm going to be teaching you or how I should teach it to you when you don't even know what it is I'm going to provide to you is such a disservice to you, and it's ignorant. That's the definition of ignorance. Okay, if you close your mind and your ears to a matter before you actually heard it all out, you're a fool. But those individuals, I like to see them leave early on, and once they're gone, my hands are washed from them. I don't have to waste my time, because I've seen over time the ones that stay like that and become charter members, they're the ones that just never want to listen anyway, and they keep emailing the same things all the time. I can't figure this out, I can't figure that out, and where's this at, where's that at, and they've done really no real work on their own to try to be organized, study, practice, work towards understanding how to do it. And knowing how to, number one, define a market in terms of high probability, low probability, that's a skill set that every long-term, successful, consistently profitable trader would want to aspire to know. But sadly, when you first start out in this industry, the only thing that's promoted is high probability or high odds winning entries. Ultra tight stops, big profits, lots of trades, high frequency winners. That's the kind of thing that is used to lure you in. And I've fallen victim to that stuff when I was first starting out. But it's important for me as an educator and a mentor to keep you grounded and having a mindset that is not only sober about what it is you're trying to do, but also keep you within a realm of realistic. And the way I keep things realistic for my students is showing you the other side of the marketplace where you're going to blow it. Even with my concepts, you can blow it. So being under my tutelage, under my wing here, you get that insight. You get to be able to see what it looks like when it's not likely to work. And that's mastery. That's how you know someone knows what they're doing. If nothing else, this past month in December should have communicated that in flying colors. Like, it should have been perfectly clear how important it is to know the difference between high probability and low probability. But I'm looking for lower prices on euro. I'm still higher on dollar, and that would be lower prices on euro. And I'm still favoring that 111.68 level. All right, again, 2-hour chart here only because I want the clearness of the chart candlesticks and still show the dealing range low and dealing range high. You see we ran up here, bumped right outside of that range a little bit, and broke down, created an imbalance right there. Okay, so all of this back and forth, spending multiple passes back and forth, and until we get to here. One single pass, one candle, then we have the candle open here, runs down, so there's an imbalance right there. Sell side imbalance, buy side inefficiency, and the market does not completely close that in, which is nice. We want to see that. And then breaks down and runs for low resistance liquidity run signatures, low with a higher low to the right of it. And then we have another pool of liquidity there. And this is the same thing that is there. So the next area is under here, and then under here as well, and then down into this level here. So we might want to have to come up into that a little bit here, work inside that 113 big figure again. It's better if it doesn't spend a whole lot of time or dig too deep into it. I like to see it stay below 113.20 and then resume to go lower, and that would be a move higher on dollar continued. But again, all we're doing is observing. I'm not trying to forecast anything. I'm not trying to push a bias on you. That's what I would expect looking at what we're having in front of us here on the 2-hour chart. So with these levels here and this level here, let's take a look at the 15-minute time frame. So the 2-hour chart, you have that imbalance that doesn't look so imbalanced here. We trade up into it here, once more here, 8:30. We take a dive down into sell side liquidity there. So all in all, that's a really nice move. Like, that would have been a real nice move to be a participant in. But again, just like sometimes in December, you're going to see moves that are real nice. In January, you're going to see hit and miss, spotty type moves. And it's important that you listen to me. Do not feel like you're missing out on anything, because what we're using the month of January for is for the entire first quarter and technically the first half of the year. We want to see what is it likely to provide in terms of long-term prognostication. It may not provide much, but we got to give it a chance to do so. Okay, so there's a lot of things, a lot of factors that have moved into this time. A lot of economic things, geopolitical things, a lot of potential war drums, with Ukraine and Taiwan. There's a lot of things that are sitting on many countries' desks right now, and they're burning the midnight oil, 24 hours. They're trying to figure out what they're going to do and what's the response to all that. And all those things are going to be factored into what the markets are going to perceive through that. So you got to give these environments and these events chance to well, have their impact. Okay, and then maybe that impact may be something that we can see coming and be able to foretell based on that, or fade that idea and what would be commonly expected because of one of those things occurring. We could fade that expectation, and what would be expected in a currency going higher could be viewed as, okay, well, it probably isn't going to go higher. Let's look for it to go lower. All those things will make more sense as we walk our way through January. But I have to see the charts to be able to do that right now. It's just too early. All right, British pound. I said I wouldn't touch this one. We moved back up into this civvy here. Didn't quite get up into consequent encroachment, but we moved up into it and then sold off in here. And I just want to show you the price action. I don't have anything in here that's really all that noteworthy. Small little imbalance there. We traded down into that. Nothing in here except for mean threshold. Last up close candle after going into the imbalance. Premium high, discount low. Sells off. And again, 15-minute time frame. 8:30 sells off. Attacks the sell side liquidity here. Nice move. I wouldn't have been a participant in it. So just for completeness sake, it's here. I want to take you over to the teaching for this video. And we're going to be looking at the E-mini S&P futures. This is the March 2022 contract. And the way you would pull this chart up is the symbol ES, the letter H for Harry, 2022. Okay, and that would give you this chart here. This is the daily chart. And I'm going to talk to you about accumulation, manipulation, and distribution. Okay, which were the main pillars to my Power 3. So when I talk about accumulation, manipulation, and distribution, most of you understand that that is a open drop down Judas swing by the low and then rally up, and then it closes near the high of the day. Okay, that is the classic understanding and how I've taught it, and most everybody understand that even on the YouTube channel. But what happens if we are in small ranges, okay, and or we're in a condition that is not likely to create a trending day? How can we anticipate and use accumulation, manipulation, and distribution? Okay, or Power 3. Well, you strip the idea away from the daily range. Don't look at the daily range as a way of creating that Power 3 formation. If you take your attention up here, look at what we've done here for this particular trading day. This is Monday, the 3rd of January, 2022. And this was Friday's trading here. So we have a market that opens here, trades down, takes out Friday's low, and then rallies up, and then comes off the high. That is an indecisive day, but it takes out the previous day's low. Now, if you don't look at what we've done so far for this day, isn't it likely to anticipate the next candle at least make an attempt to trade down into this imbalance more? So we opened here, and we traded down, went below Friday's low. Didn't get all the way down to the imbalance closure or rebalance to that old discount low, which is this candle's high here. But we made an attempt to trade lower. Now, what makes it likely to not completely close that in and go down to here? Because we're in January, because it's the first technical trading day of the year, and it's bank holidays. So it's not likely to have a large range trending day. So how do we anticipate using accumulation, manipulation, and distribution? Well, you go into the session and you treat the individual session. One session on that daily range is going to create the accumulation, manipulation, and distribution. You do not see the London session create a Power 3 and then a New York session Power 3. That does not happen, okay? So the takeaway in this lesson is, if you're looking at a market environment that the daily chart is suggesting that we're probably going to be in a small range day or an indecisive day, how do you know what to anticipate and not expect too much from the marketplace and get in, take your surgical strike, and then get out? How do you know what that looks like? Well, again, let's go into the idea of what a power 3 looks like, and we'll zoom in this little area over here. All right, and then what you have to see is a level that you would expect to trade up into. Okay, so some kind of premium level. And then your expectation would be if it trades to that, it could sell off and go down into a discount level. Okay, so just a crude depiction of what these levels are from a diagram stance, and I'll show you what it looks like in the actual market. But for now, just understand that that's what you're looking for. Okay, you're looking for a reason to expect the market to trade up to a specific level, not a range, not a zone, a specific level, and down to a specific level. And where the market's trading at now, or ahead of the move that you would expect, this sets up the sell-off. Okay, and this is obviously anything that would be reversed, but I'm making the case here with hindsight. Okay, I want to make sure you understand that this is hindsight. I'm not saying I knew this before it happened. I'm just giving you this lesson because it's useful. Okay, and it's something you can take away and apply it going forward the rest of your career. But where the market's trading at in here, we're expecting the market to trade up into a premium level. So once that runs up in it, that's your Judas swing. Okay, and I'll show you what that looks like in the S&P today. But that's where you would sell short, and your draw on liquidity would be down here. And that would be Friday's low. So we'll use the opening price at 8:30 for this level here. Okay, and then here is the Friday low. So that's the framework I'm going to give you here. Friday's low is that level here. And then the opening level here, that is the opening price at 8:30 in the morning. And we're using that operating time of 8:30 in the morning to 11 o'clock in the morning, New York time. Okay, you don't have to worry about flipping times back and forth. Whatever the local time is for New York, there you go. Okay, so it makes it very simple. And if you're going to be using it for index futures, this is going to actually serve you pretty good. And then you expect that sell off. And then once it gets below the Friday low, because we're expecting small range day, we're expecting the power 3, the only form inside of a trading session, and then come off that low. And then we don't care what it does the rest of the trading session. It can go higher, consolidate, whatever. But this movement here, where it opens, rallies up, raids a premium high, or goes into a premium array, sells off, goes down to a discount array, which is sell-side liquidity below Friday's low. That's the framework for this particular day. So we're going to go into the hourly chart here. Imbalance. We came up, completely rebalanced all that. Then we broke down. This candle here, we open around 47.75, trades up to around 47.85 or so, into this small little gap right there. Consequent encroachment, low, high, hits it there. So there's your structural framework that it could trade up into this level here and then attack the sell side below here. Okay, so this low, 47.50, anything below 47.50, that's your target. So we're seeing it run up into this level here, and then we would expect it to sell off. Now let's drop down into a lower time frame, 5-minute chart. Okay, and I want you to take a look at what we've outlined here. 8:30 in the morning, here's the opening price. And watch what happens. Rallies up. There's your Judas swing, takes out the opening price here. There you go. There's your opening price at 8:30. It trades above that, then washes out, trades lower, goes down below that 47.50 level, trades to it here, and then just goes in consolidation. But this movement here, that is the accumulation, manipulation, distribution, or power 3. And it's inside the daily range. Notice that it's not obvious anywhere else in the day. We're seeing it open, rally up, sell off, buy it back, get out. Open, rally, sell short, take your profits below 47.50 and get out. There you go. So the opportunity and the way you train your eye and or not overstay a small range day when it's likely to be a small range day. And again, I am not trying to induce this, oh, I can trade January. He's telling me I can trade January. No, that's not what I'm doing. I'm stating that when you see the economic calendar or the seasonal tendency, the economic market structure, the everything that's going on at the time when you're looking at charts in the future, when you don't have me with you, you want to be able to rely on your own experience. And if it's not likely to create big range days where it's one directional and it opens near the high or low of the day and it closes on the opposite end of the range, that's typical power 3 on the daily chart or daily candle. When the daily candle is not likely to be that perfect and it's back and forth, you want to focus on the trading session. Okay, and the easiest one is obviously do 8:30 to 11. They're easy operating hours. It's 2.5 hours of time, and it's a small window of work that you have to monitor. But the framework is this, and you should be able to see that here. Now, I apologize. This level here would have been a level I would have had drawn here at 47.50. And again, I'll take you back up to that. 47.50 is here. Okay. And that would be a level down here. It would represent that. So from a classic diagram stance and viewing it conceptually, it looks like this. But in a chart of actual price action, we see the opening price at 8:30. It rallies up, sells off, and goes down and runs the low at 47.50, and then comes back in deep. And who cares what it wants to do at that point? Because we're in a day that's likely to be a small range. You want to get in, take your surgical strike, get out. Okay, and this is how you use it going forward. Not during the month of January, not during the month of December, but any time when the market's likely to create a small range opportunity and it's not trending. This is how I know not to stay in those days too long or hold on with my partials, leaving a big portion on and then watching it just go again, something like that. That's a painful lesson I had to learn. So this is a very powerful education, but you're probably not going to appreciate it until you start seeing it in hindsight, studying it, and then seeing it happen in the future. When you look into economic calendar, I say it's probably going to be small range days. Look and see if these things don't form like this. Okay, now let's go back out to the idea of classic index trading. Well, you have your high here, higher than 8:30 in the morning, higher high on NASDAQ, E-mini, and then look what we have here, the Dow. There's your bearish SMT diversions. Okay, so you have smart money still communicating here. This is a stop run. This is a stop run. Heavy distribution in the Dow. That's a good short. Run to Friday's low. Get in, get out. Done. Okay, so all in all, for about 30 handles or so, which is very nice on a small range day for E-mini, that is a very, very nice surgical strike. And you can mark this all up on your own, in your own charting, and that way you can have a record of it. But the teaching today was looking for this accumulation, manipulation, and distribution cycle inside of a small range day. Notice again, it's not happening in both London and New York. You're only looking for it to form during a high volume time of day. It's a bank holiday. It's the first trading day of the year. And it still forms between the 8:30 and 11 o'clock window I taught, even on YouTube. Okay. For 2.5 hour window of time to be worrying about anything in index trading, that's your sweet spot. That's just a real nice way of going in and anticipating it, seeing it, and knowing when to close up shop. Once it took out the Friday low, who cares? It could have went lower. But chances are it probably won't. Why? Because of the climate. The economic calendar suggests that, it probably isn't going to be a large range day. It probably is going to be a quiet day, and it ran just for the stops below last week's low. That's how you want to think. That's how you want to have these expectations in low range or low volatility conditions. So that way, I'm teaching you exactly how to trade small range days. So that way, if you're in like competitions, okay, or if you are in, like say, I'm not suggesting any of you should be doing funded account challenges between the month of, or the last part of November to February. If you've ever had that inclination that you want to do that, Do not do your challenges during the month of December and January. Okay, go like the second week or so in February until around May. Anytime during then, as long as you've been learning well here, I think you have a better chance doing that. But you're really stacking the odds against yourself if you try to do a challenge to get funded at a prop firm or whatever, if you're doing it on December and or January, because the markets are ugly. There's a spotty. But let's say you're trading at a time when it's not those months, okay, and you have dwindling time left in your challenge and you're trying to pass it, and you've invested your money into it and you want to obviously see your way through it. You can use a concept like this, where even with the small range contractions that are occurring in the daily ranges, you can still go in if everything is equal, and assume that you've learned everything I've taught in the core content. You've done well, you've practiced, you know what you're looking for. This can be that little bit of a secret weapon, I guess, to get you through small ranges and then finish out your challenge. It's not to force a trade. It's not to, well, I have a couple more days left in this month and I've already up 25%. Let me see if I can juice it to 30 and do this too. That's not what I want you to think of it like, okay? You can also use these types of days to fix some days that have caused you drawdown in your month. Okay, for instance, say you had a pretty good month at one point and you're up, I don't know, say 15%. I don't want to make that sound like a great or not a good enough return, but let's just say you're up 15%. And then you drew down to 8.5%. And you really would feel confident if you could just bump yourself back to 10%. You couldn't get the 15% by the end of the month. But say, from 8.5%, you want to bump it to back to 10% and be content with that for the month. Okay? Then you can use, if we're going to be small ranges, you can use an event like this, okay, where you're going in, looking at just the kill zone, okay, or the trading session, I shouldn't say kill zone, the trading session, to look for the accumulation, manipulation, and distribution, not the entire daily range. Because there's an expectation that when students come to me, they say, okay, well, he's teaching Power 3, so every day that's bullish, it should look like the classic open near the low, close near the high. And that's not what happens. Okay. Obviously there's days that's indecisive, there's days that are reversing, there's days that are false reversals and they continue to go through the next day. So that brings with it a measure of risk. It also brings with it a measure of understanding that's required, and that understanding is what you're getting here. How to go into these small ranges and just focus on just the specific time element of a session and not require all of the daily range. So again, I submit this humbly to you. That way you can consider how it will fit in your own repertoire. But don't try to make this more than it is. It's not a guarantee to make sure you can find a trade every single trading day. But when I was doing those escapades with those demo accounts and running them up real quick, I was using this type of tool as well. I was going in, and if it was going to be a small range day, it's okay. I can go in there and wait for them to manipulate the market and then work inside that little session. Once I get my Power 3 during the session, surgical strike, in and out, done. And sometimes the market didn't do anything after that. Sometimes it went way beyond what I was doing, and it's okay. I'm not worried about it, because your job as a developing trader is not to be perfectly short at the highest high and covering at the lowest low. That's not your job. That's not your objective. That is not why you are here. If that is, you're going to fail. You're going to set yourself up with unrealistic expectations, and you're never going to be satisfied. You're going to be looking for these silver bullets, these magic little concepts that don't exist, that's going to make you perfect. And perfect is not likely to be had. Okay, believe me. I think if it was possible, I would have found it because I'm obsessive. Okay, but you don't need that pursuit of perfection. Now, being persuaded by perfecting your craft, that's not the same thing as what I just stated. Okay, so improving yourself continuously, that's a pursuit of perfection in your craft. But trading perfectly, that's never going to happen. Your entries are never going to be perfect. Your exits are never going to be perfect. You're not going to be in the best move. You're going to be looking at, oh, I wish I would have did that market or that indice or that pair or that stock or that commodity. So there's always going to be something you can go back and look at and say, I did that wrong. Now, you can do that and torture yourself, or you can say, this is enough. And that's all you're doing. You're trying to be content with progressive improvement over a long career. And as long as you have that mindset and that aspiration and you follow the rules I'm giving you, I think you'll be pleased with where you get to. Until I talk to you tomorrow, be safe.